The May non-farm payrolls could determine the fate of the dollar until the next FOMC meeting on US interest rates. I'm joined by IG analyst Alastair McCaig. Hello there, Alastair. Now, first of all, what are non-farm payrolls?
Non-farm payrolls are pretty much what they say, really. It's the employment change for the US markets, stripping out the seasonality of the farm industry, obviously affected by weather and time of year, giving more of a vanilla picture as to how the employment scene is in the US.
How predictable is this data?
Pretty unpredictable, it would be fair to say. There is always expectations that the market have, and part of the reason there is so much unpredictability about it is they're correlated so quickly towards the end of the previous month, the first Friday of the next month, giving so little time for the numbers to be crunched, and this does lead to revisions that can be quite a bit away from where the original figures were.
They've been quite volatile readings, haven't they, over the last few months? I mean, talking in terms of trends in the US job markets, though, still pretty positive?
Still pretty positive. I mean, there's a picture that's being painted towards the US being able to raise interest rates as far as their own economic data is concerned, maybe cooling just a little bit, and non-farm payrolls possibly fall into that bracket as well, especially when we look at the revisions for the last 3 months, which have actually come in lower than the posted figures. But it does point towards a picture of the US being able to raise interest rates. I think part of the hesitancy that the US are maybe incurring here is the fact that there are so many other regions and countries around the globe that are in fact cutting interest rates rather than rising, and they are swimming against the tide in a little bit.
So in terms of the outlook for interest rates, it depends on whether this data is higher or lower than expectations as to where things go.
Well, Fed Chair Janet Yellen has obviously stated there are a number of barometers they're going to utilise to dictate their decision-making, and this certainly falls into those brackets as far as the employment scene in the US is concerned. It does give a very good, quick snapshot of how the employment scene is, but it'll only be one of the key barometers rather than the most decisive one.
So we've touched on the outlook for interest rates. What about the outlook for the currency markets? Because they might well be affected by this data.
Well, for so long, it's actually been the dollar side of all these currency crosses against, say, the likes of cable with sterling or euro dollar. It's been the US dollar side of the equation that's been the driving force. At this point in time, though, it would be fair to say that certainly as far as euro dollar is concerned, it's the European side of the equation that is weighing more heavily on the market volatility. And certainly in the last few days, we've seen a pretty aggressive spike higher. This is maybe as the currency markets factor in a greater chance of the Greeks leaving the Eurozone, and that negativity that they bring towards the euro as a currency may be diminishing.
Alastair McCaig from IG. So keep an eye on the currency markets, but meanwhile there's still potential for the first Fed rate hike or move to come before the end of 2015. But the timeline might have slid a bit till September. For now, though, all eyes on those non-farm numbers.